Cool. So today we're gonna talk about divergences and trading them as part of my How to Make It Trading ES Futures part-time course. As always, this is not financial advice, and meant for educational purposes only. So to get started, we'll talk about the awesome oscillator and divergences based on this indicator. To sum it up, the AO divergence trade, an AO divergence is considered to be in play when price makes a low and then a lower low, if we're looking for a long, or a high and then a higher high if we're looking for a short. So price will go low and then go lower. And at the same time, the awesome oscillator will make a low and then a higher low for a long, or high and then a lower high for a short. We'll get to some visual examples on the next slide. Trade parameters or criteria or instructions summed up here. So we'll enter on the bar color change of the awesome oscillator. We'll use the same parameters as other trades we've talked about so far. For instance, like putting the stop at 20 ticks if we're on the 16 range chart, or 40 at the 32 chart, etc. Aim for 3R profit like we do on the other trades. And then we can also add on the AO zero cross. And this type of setup tends to go well with additions whenever we get the zero cross. So in line with what we talked about when we specifically went over the zero crosses, can be a way to get more EV out of trades that we take. I mean, especially with AO divs, they tend to work well. So this is a long example. We've got price going down, it makes a low, and then it makes a lower low. At the same time, the awesome oscillator makes a low and then makes a higher low. So we can say between these two peaks or points of price and AO, there's a divergence. Price is going down and AO is going up. So we'll enter on the bar cross, which here would be this candle, which is nice, sets us up nicely. We enter, we use the same parameters as we've talked about before for trades. So this is the 128 range chart. So we do a stop 160 ticks away, and then 3 times that for the take profit, which is 480. You can also see we've got the AO cross here, which would be somewhere in this structure, I think this candle. Whenever this happens, we could, consider support on the awesome oscillator side that the divergence is playing out. We've had our push and bullish momentum, so it could be a nice spot to add on more size. Obviously, this is a pretty fair distance away from the original trade. The original trade has already played out and already gone into profit here. So could re-enter with like a looser stop and a less risky take profit. We could leave the trade running until after this enters, and then some sort of similar parameter. So maybe if the original stop was 160, we could do 240 for a stop, which would put it somewhere down here, and then target 240 up here for a take profit. Lots of ways to play it, and just represents more value from the trade here. This will be another example. I think this baby is a 2-for-1. So here we've got a short example. Price makes a high and then a higher high, while the AO makes a high and then a lower high. So we've got the divergence here. We enter on the bar cross and target 3 times our risk. We get an AO cross somewhere here, I think. So could re-enter the trade, could just add more size with the original parameters. So like enter more short here with our same stop where the first stop was and our same take profit where the first take profit was, or could push the take profit down a little bit. Lots of ways to play it. And then here we've got another long example. So this one, the AO structure is a little bit strange. We've got a low and then a higher low and then another higher low. The first higher low isn't supported as being a divergence because price makes a low and then a higher low also. So if we drew something between these 2 points, it would be, have an upslope to it. We could consider this to be a shadow divergence, which we'll talk about down at the end of the presentation. But for our purposes, we'll pretend we kind of ignored these and didn't do anything. But then we got the second higher low, which sets us up into this kind of triple divergence structure on the AO. And we did get a lower low on price. So could have entered the trade with similar parameters. I think on this specific one, the actual bar cross was here. So we could have gotten stopped out entering there, and then just re-entered as the trade was seen to be playing out. On this one, pumped a huge amount. So on the AO cross, could have just re-entered a similar trade to the original one, with the 80 tick stop and then a 3x risk. Could have added size, could have let the original run longer based on the cross. Um, but a couple good examples here. So that was divergences on the awesome oscillator. Now we'll talk about divergences on the stochastic RSI. Fairly similar in terms of thought process and trading based on it. So a stochastic RSI div will be considered to be happening. Same criteria for price, a low and then a lower low, or a high and then a higher high. At the same time, we get a stochastic RSI cross at a low and then higher low in a long instance, or a high and then a lower high for a short, similar to the awesome oscillator. With a stochastic RSI, we consider it only to be a divergence if it's within the same stochastic rotation. So if we get across and then we go all the way down, to the over or sold area and then back up and get another cross, we wouldn't consider that a div. In order to be a divergence, they have to happen without an entire rotation occurring in between. Pretty similar parameters. So once the divergence is confirmed with the stochastic cross, we'll enter on that cross. Stop at the same parameters, aim for 3R profit. Can also use the awesome oscillator for confirmation or adding on the AO cross. More ways to get more confluence or to size up if we get more confident in the trade we're taking. Here's a first example. This one, so price makes a low and then a lower low. And the stochastic puts in a cross and then puts in a cross higher up. So considered to be like a low and then a higher low. Same kind of thought process. So we enter on the cross, 3R risk, same parameters. So this is the 128 range chart. So we would do a 160 tick stop, 480 tick take profit. Same trade, but looking at the awesome oscillator, so we get a different colored bar close here, which I think is one bar later than we have the stochastic. So you could have entered more size here, could have waited to enter the trade there. I think if we entered on this candle, we would have gotten stopped, but then we would have gotten another chance to enter with another AO bar close here. So could have entered this one. If we had entered on the stochastic cross, we could have sized up on the second AO bar cross. And then we'd also get a later AO bar cross while the original trade is still in play. So some additional confirmation there, and then we get the AO cross somewhere up here, so could have added size. Yeah, ways to, think about this trade. Also, just a valid trade based on this slide, just enter here. Don't do anything else or any other management and just let it take its play out. But if we wanted to manage it and add in more size or, adjust parameters based on what the awesome oscillator is doing, there could be some more EV to capture based on the additional steps in thinking and gaining confluence. This is an example of a short. So we get a high and then a higher high on price. We get a high cross and then a lower high cross on the stochastic. So price goes up and the stock crosses go down. So we could consider this to be a div, enter on the second cross, target 3 times our risk. Over here, a similar kind of thing, like a long example, where we get a low and then a higher low on the cross, while price makes a low and then goes a little bit lower. So kind of 2 for 1 in this example. It didn't do anything with AO, but you get the picture. So these signals can be used counter trend, which is an important distinction. So whenever we talked about the basic trades and adding AO to the basic system before, it was always in line with market structure, the trades that we took. And this, the divergence in momentum, is telling us that we're likely to be at a top or bottom, especially with the awesome oscillator. AO divs in particular can be powerful top or bottom signals. If we do get divergences that are in line with market structure, that would be another point of confluence that could give us higher confidence, especially with the stochastic divs, just because the stochastic RSI is a more sensitive indicator. We'd be a little bit less comfortable trading counter trend just based on the stochastic RSI. But if we get divs in line with market structure, there could be good signals there. Um, for instance, yeah, with this trade here, you can see we have a low in price, and then we have a high and then a higher low. So based on, market structure, it's in line with taking a long trade. So the stochastic div is in line with market structure, so this would be a trend following trade, which we generally like taking more than, if we were trying to short between these two peaks, which also would have been a valid trade, but we would only have the stock divergence to go off of, and it would be counter to what price is telling us in terms of trend. The trend is your friend. So after a divergence, I recommend skipping at least one following signal the opposite way. Because a divergence acts like a sign that momentum is likely to be strong in the direction the div is pointing, I will tend to be cautious in taking trades against that trend, especially with awesome oscillator divs because the AO is a slower indicator. It's likely to remain in play for a long time. So if you have a divergence that's in play or one recently, I would recommend against taking trades that point the opposite direction. So in this example, we have a short divergence. Price makes a high and then a higher high, and then on the stock we get a high and then a lower high. So you could take this trade, or if you weren't in this trade and you were looking for like a long option afterwards, we can see that price generally has been trending up. We're above the EMAs, but if you just entered along on the first stochastic cross afterwards, you'd get stopped out. And the divergence would act as a warning sign to not be hunting for longs, like shortly after this happens. So it'd be smart based on this divergence here to skip this signal and this one, and to just let stuff play out a little bit more before we look for that long. We can see that price goes all the way down here. So like entering along here could be valid. Well, actually, in this example, we have a low here and then we're lower than there. So based on like the market structure, entering a trade here would not be considered valid. But then the stochastics does put in a divergence and the AO puts in a div too. So could be valid to enter a long, based on this divergence. This slide is illustrating just that if you're entering longs too soon after a divergence begins playing out, you're likely to get stopped out. So if you see a divergence in the charts that you're not actively trading, um, it's smart to just sit on the sidelines and not try and counter trade it either. This slide, looking at the awesome oscillator, kind of gives a way to think about price action versus what the AO is telling us. We've got a divergent structure down here on the AO. Price is going down, the AO is going up. So this could be considered the divergence, and then this part here is the play out. When the AO is pushing bullish, we get the AO cross. And at some point up here, the AO is going to lose momentum, and we're going to consider the divergence to be played out. We can consider all of this price action the play out. So while something like this is happening after an AO div, I wouldn't be trying to get shorts. Up here, we actually get a bearish AO divergence. So we have a high and then a lower high. Price makes a high and then a higher high. So entering a short based on this divergence would be valid. And we can consider the divergence to be played out at this point. And similarly, down here we get this price, this bearish push in momentum that is showing us that the bearish divergence is playing out. So I'd be cautious hunting for longs down here. We get another, div structure here. So maybe by the time this stuff is happening, I would start looking for longs again. And you can see that entering a long based on this area of momentum could have worked out well. I think last for this presentation, we'll talk about shadow divs. This is a term that I've coined um, based on an idea or a phenomenon I've seen while trading. The idea behind this is the stochastic RSI or the AO is putting in a divergent structure, but sometimes price action doesn't match. So the AO will look like a textbook divergence, except price isn't making that higher high or lower low. So price makes a low and then a higher low, which would be bullish, and then the AO makes a low and a higher low, which would be like a bullish divergence on the AO. You can either trade these like they're a regular divergence trade, or you can just use them for information, for added confluence to existing trades or trade ideas. But they're definitely an extra piece of information the chart can be telling you, regardless of how you choose to play them. So in this area, like we have a stochastic divergence playing out. So you could enter the short here. But then over like a longer period, there's a shadow divergence on the AO. So this area is a high and then this is a lower high, and the AO is also making a high and then a lower high. So based on that, we could enter a short on this bar cross after the shadow divergence is played out on the chart, or shown us that it's present. So we could enter another short here. We could leave the original short on longer. Um, we could add on the AO cross. But this information on the awesome oscillator tells us that we're likely to be pretty bearish for a while. So maybe we, get more greedy and aggressive with the take profit on the first trade. Maybe we add size, put an extra point of data that the chart is giving us. Here's another one. So in this one, we get a bullish AO divergence back here. Price makes a low and then a lower low, while the AO makes a high and then a higher high. The stochastic also matches, so we get a stochastic divergence and an AO divergence, which tends to be a pretty good signal when they give it to us. So after the divergence is put in, we could enter a long, and this area should represent a playout, but price just continues to be weak, doesn't get above the EMAs, and very like shallow bullish push on the AO. We can see that the AO makes a high and then a lower high, and then some very weak crossing, just like a lot of weakness after that. We could consider the first 2 points to be a shadow div. Really, it's telling us that the AO is not pushing bullishly very strongly. Like we would expect, like a big bullish push, similar to the absolute value of the momentum that put in the original bearish div. But it's just not telling us that, and price isn't either. It's like a warning sign to not add on size to the original trade, to get out, to take profit early, and that sort of thing, before price just dumps again, and the bearish, weakness plays out down here. In this one, we get a high and then a lower high on price. The stochastics kind of pushing it, but could be considered to be a shadow div here. Almost an entire rotation takes place, so not super clear, but it's telling us something. At the same time, the AO is putting in a high and then a lower high, so an actual shadow divergence here. This example is showing it just being entered like a trade, so entering with normal trade parameters with a stop and targeting 3 times the risk. So this is an example of how you could just enter and treat it like a normal trade and be successful trading a shadow div. So that's it for this presentation. I like divergences a lot. They tend to be um, like most of what my trading actually is, or most of the signals that I do take. Like I said originally, the system will generate a lot of signals, and the artistry and skill behind it is filtering down the signals and taking the best of them. Especially AO divergences will tend to be the best signals that you get. I think in a later presentation, I'll talk about kind of trade hierarchy and how to weigh different signals against each other. And AO divergences are the strongest signals and the ones that I'll give the most weight. And, you can get a lot of info from stochastic divergences too. Just on this screen, there's a stochastic div up here, and you could have shorted on that. So once you like start noticing these patterns and looking at charts, you'll pick them up everywhere. There's definitely no shortage of trade signals to be taking that generate a lot of value. Anyway, I'm rambling. I'll cut stuff off there. Thanks for watching.